In this week's Yahoo U, we are looking at the correlation between rising bond yields and inflation risks. Brian Cheung itching to break this down for us all week. And Brian, it's worth noting that we're talking about this because we saw the 10-year yield jump or see the biggest weekly jump in 7 weeks this week.
Yeah, and it's looking like right now it's still at pretty elevated levels comparatively, about 150 basis points. But class is in session. And here's the thing about the bond market. Okay. So trying to figure out why yields are going crazy is almost like trying to ask a baby why it's crying, right? The bond market's not going to tell you exactly what's wrong. It could be inflation expectations, it could be people's feelings towards stocks. But all you know is that you can't go back to living your life until that baby stops crying. So let's try to see if we can figure out the curious case of higher yields this week. Let's pull up some slides here. And we want to first rewind to Bond Yields 101. You might have to rewatch our piece on bond yields, which you can find on our site, yahoofinance.com, under the Yahoo U landing page. But the most important thing you need to understand is that the market for US government bonds is widely considered to be a risk-free asset. And when people buy US Treasuries, it's generally considered to be a flight to safety. So when that happens, the price of the bond goes up, the effective yield on the bonds go down, which means that in reverse, when people are willing to take on more risk, they sell US Treasuries and the yield goes up. This was not happening this week. This is what was happening this week. So let's take a look at the two-month chart of the yield on a longer-term US Treasury. This is the US 10-year, and keep that in mind, very important. And yields have risen over 40 basis points over that time. And you can't blame people for the lack of loving US Treasuries, right? Think about the fact that if we are at 150 basis points right now for a 10-year security, you could get that kind of yield in a single day off of many stocks, right? And this is especially true when you think about things like inflation. So let's say, for example, Akiko, my esteemed co-host, she expects inflation to be 2.5% over the next 10 years. Now, that's going to erase your nominal, not inflation adjusted interest that you might earn on a 10-year, which again, about 150 basis points right now. So if you think inflation is going to be less than that, you might make a case for buying government bonds. If that's not the case, then you don't see that case. Now, there's a nifty tool, though, called Treasury Inflation Protected Securities, or TIPS for short. And Akiko can buy a US government bond of the same maturity, let's say 10 years, and the payout on this security is actually going to go up when inflation goes up, and vice versa. She's going to get, in other words, a real, which is the term for adjusting for inflation, payout on this bond. Now, we can see the value of this, right? People would want tips when they expect inflation. In that case, yield goes down. And people who don't expect inflation don't want tips, in which case the yield goes up. So here's what I want you to watch very carefully. This is the yield on a US 10-year TIPS. And while it's gone up certainly over the beginning of this month, you've kind of noticed how it's plateaued over the course of this week. Very interesting dynamic there. So as the yield goes up, people aren't expecting inflation. All of a sudden, people are going, maybe there could be something coming with all this stimulus, right? So more inflation means no bonds for me. I'm going to go towards riskier assets, stock market to the moon. But here's the problem. That didn't happen this week, right? Bond yields went up and the stock market went down. So this shift towards riskier assets, at least on that front, hasn't appeared to materialize, which means there could be some alternate explanations here. Here's one: changes in time preferences. So again, we were looking at the US 10-year, but keep in mind that investors can rotate from longer duration to shorter duration for reasons like the Federal Reserve. Now, the bond yields serve as a proxy for borrowing costs, which means that on the short end, if the Fed is going to keep short-term interest rates low, investors will probably follow the Fed in pinning down shorter-term Treasury yields, showing no love for 10-year, which could take the yield up. And then lastly, there's just good old supply and demand, right? More government debt from more government spending means that if there's something like $1.9 trillion on the way, a flood of supply could further turn off investors if they don't find those securities attractive. And there's also concern about regulatory issues at banks, right? They're some of the biggest buyers and holders of US government debt. There are rules like the supplementary leverage ratio that determine their ability to absorb government debt. But again, I'll leave that for another day. That kind of wraps up my slides here. But again, Akiko, this is all very confusing, but that's the point. If anyone tells you, well, the reason for bond yields moving up is for this singular reason, it's just simply not true. And that is this week's Yahoo U.
Yeah, an important lesson to keep handy, especially if these moves continue the way they have over the last 5 days or so. Thanks so much for that, Brian.